Hey, welcome to the show, Total Financial Solutions Safer Money Hour. I'm your co-host, Jeff Gerard, soon to be joined by your host, Arif Halaby. And we have a special guest for you today, going to bring you some tips and tricks in the auto and homeowners insurance world. You know, from time to time, we talk about some of the other areas besides retirement and income planning when it comes to your family's finances, because we know how important it is to have a holistic plan. So today we have Mr. John Gonzalez from Key Partners Insurance Services right here in Santa Clarita. John, welcome to the show.
Thank you for having me.
Yeah, of course. It's a pleasure to have you on. We're going to talk about a couple of things. Your company, maybe you can give us a little bit of background on yourself, your time in the insurance business, maybe. Whatever you feel comfortable sharing as far as your business goes.
Yeah, so I've been in the insurance business since the end of 2007. I started with a carrier with Farmers Insurance until 2015, and then I transitioned over to Key Partners Insurance, which is a local small independent insurance agency, which gave us the opportunity to represent multiple carriers. But about 10 years total in the insurance industry.
That's great. So you've actually been able to see some of the fluctuation in the market as far as losses that have been out there. You've seen fires, you've seen floods, you've probably seen a whole host of different disasters and perils that, which are kind of the insurance world buzzwords for people. You know, they're losing money or their houses are burning down. You know, we've just had some recent fires happening, like the Sand Fire happened out here in Santa Clarita. That caused a lot of damage to local homes. So, I mean, when it comes to that sort of thing, you've seen quite a breadth of had a breadth of experience in the insurance world, I would say, in that decade or so.
Definitely. In the very beginning, you wondered, you know, are claims all that frequent? And now it's to where through the years, I feel like we've seen a lot of them. We've been blessed, knock on wood, without many earthquake losses at this point. But
sure.
Other than that, I feel like we've seen as an agency pretty much a big run-of-the-mill of what's out there. So
one of the most important questions I have, at least as a consumer and before being in the insurance industry, about the same amount of time that you've been in that, one of the questions I think was on everybody's mind is, do I go with a captive agency or a broker? And let me define captive. Captive would be something like where you mentioned a Farmers or, you know, some of the big three, we call them sometimes. I won't name them all, but you kind of get the idea, where an agent or an agency represents one company and its product line. So that means that they're subject to selling and offering only, and I say only with an asterisk, they may have a whole suite of products, but you're only allowed as a captive agent to sell the products and offer the products from that particular company that you represent. So essentially you represent the company, whereas a broker, and I'm going to give a little bit of favoritism to a broker here, is whereas you can come in and kind of represent the client, go out and look at the market of all of the different carriers and the different products and select what you think, in your opinion, might be the best for your client at hand.
That's exactly correct. And that's really, I mean, not to say, obviously we wouldn't be in our model of distributing insurance products if we didn't feel it was better. But the ability to give clients options and really find what we like to call the right fit. Not always so much price sensitive, but maybe a carrier will have a certain endorsement bundle or limit or sublimit that fits a certain client's need. Mm-hmm. It's nice to have access to multiple options. And then again, like you said, the insurance market is extremely cyclical. So as there's ebbs and flows, we can find the right fit as time progresses, because things change. That's for sure, as things will always change. So
that's right, and I like your ability to navigate through those changes, whether they're industry driven or disaster driven. I mean, we've seen insurance companies just shut down their homeowners insurance division.
Correct.
They just will stop selling a product because, and I've learned this word from you, you know, that the kind of a buzzword is like taking rate. You know, when a company's taken on too much loss, they basically, if I'm correct, chime in here, John, about not offering a product because of that.
Right. They either have to take enough rate to where they feel like they can be profitable in that, or they eliminate exposure that they're not comfortable, that they don't feel like they can properly price for. So a perfect example in this area, anyone that lives out here probably knows if you own a house, brush is a really, really tough thing.
That's a big thing out here.
Right.
Yeah.
So it's hard to find a carrier that will bundle in a brush area. When I say bundle, your home and your car insurance together, that's the most cost efficient way to buy it. As carriers' appetites change for brush, it becomes harder to have a bundled package in certain areas of San Cruz Valley. So that's one thing we've worked hard on, actually, is making sure that we have really good relationships with carriers that will write in this area so that we have good solutions.
And we've seen, at least in the time that I've been in this valley, maybe the last 6-7 years, we've had a number of fires out there. So that's going to also cause a problem for some folks that are looking to, maybe they have their favorite carrier, their favorite insurance company that their grandfather and grandmother had, that their parents had, and everybody in their family has had this specific agency or company. That relationship is very, very big, John. You know that, especially as more generations come through. They say, "Hey, look, my kid's going to start driving. You're going to get your first policy with my guy or my girl, right?" I mean, we see that happen pretty typically, but now you get into the big boy world where they say, look, you want your bundle. You want your auto and homeowners together, generally speaking, for that discount. What's a typical discount you're seeing without throwing too many numbers or percentages out there?
Anywhere from 12 to 20%, depending on the carriers.
Oh, wow.
12's on the low side, 20%'s on the high side.
So almost a fifth in some cases.
It's a big difference in terms of pricing.
And if you have your preferred insurance company for your automobiles, but you live in a place where maybe they won't write that,
Correct.
They won't offer that because of that brush area or that exposure, what do you do in that case?
Well, you one of a couple things. You either buy them both on what they call a standalone basis, and unfortunately, from a pricing standpoint, it's a little bit more expensive to do that because you lose that discount that you're talking about. Or hopefully you find someone that can find a bundled product for that situation. And so, and it might not be your favorite carrier, and it might not be the one that you've dealt with for 35 years. So we get a lot of calls through some of the real estate partnerships that we have. It's like, we've been with carrier, whoever it may be for a long time. We're moving to this house and they won't take it, and we're not really sure why. And so we try in those situations to educate how carriers evaluate brush exposure and just let them know the options that we have, either on a standalone basis or on a bundled basis. And so, that you hit on the head, a scenario that we deal with almost daily, at least weekly, where they're moving into an area and their carrier or carriers that they've always worked with have what they call don't have an appetite for that area.
Right. So. That's another word I learned from you, appetite. That's a nice way of saying we either want you or we don't want you, because that's how insurance companies talk to us. Kind of like if a bank wants your money, if they want it, they're gonna offer a really high interest rate. If they don't say we don't want it. They just offer you, all the numbers on the right side of the decimal. So when it comes to the insurance side, I guess they're no different, because there is a profitability that has to be maintained in these situations. Let's get into a couple more specifics here, John. When it comes to the liability part, if you don't mind breaking down a little bit of the insurance policy.
Sure. And
some of the parts. It's kind of a dry subject in some respects, but it's important nonetheless, because I think people drive around, I was going to say walk around, but they drive around thinking they have something they don't.
Correct. Or thinking that they have something that they do, but not quite to the extent that they would hope for in a real bad situation.
Let me give you a good example of something I carried up until I met you some years ago. I remember being, 16, 17 years old, and I had a pickup truck, and this is back before insurance was mandated.
Right.
So I'm kind of dating myself here. Before you had to have insurance to register your car, I was kind of in between jobs or whatever, kind of just being a 16-year-old kid. And my cousin wanted to drive my truck. Mm-hmm. And she's about 10 years older than I am. And she says, "Don't worry, I have insurance and I can drive any car I want." Mm-hmm. Is that true?
Generally.
Really?
Generally, no.
Generally, no.
Generally is the preface to my answer.
Oh, generally. Okay.
So generally, insurance follows the vehicle, meaning if your vehicle has insurance,
there you go.
That policy would be what they would call primary, meaning it would respond first in the event of a loss. Sometimes, depending on what carrier you have, if I have an auto policy and I drove your car and your car wasn't insured, my policy would respond to that, but it's definitely on a case-by-case basis.
Yeah. So just something that I thought was kind of quirky and funny, but turned out that it wasn't, a black and white, hard and fast rule. So
right.
That's what it was.
So generally what they call it, insurance follows the vehicle.
There you go. And I think that's a safe rule of thumb. If
Correct.
you operate under those premises, then you kind of should be in a safe place when you're driving a car. Okay, and then in terms of liability coverage, what would you say to someone if they say, "Look, I don't have insurance, I'm getting it for the first time," or you see someone that has maybe the lowest limits, just what are the standard limits for California?
So the lowest
limits?
California, the state minimum limit in California is there's two different components. There's bodily injury, which is heaven forbid you are at fault in an accident and you cause an injury to someone. So the bodily injury state minimums are $15,000 per person, $30,000 per accident. And then property damage, those things you hit, vehicles, fire hydrants, light poles, and they all get hit.
They do.
The state minimum there is $5,000. So there's not, in today's day and age, a lot of vehicles that you can hit and cause damage to where $5,000 will solve your problem.
And I was just going to say that. You hit it on the head. I don't think that's going to save very many people out there.
No.
The accidents I've seen out here, even, commuting locally, just on the streets alone, I've seen some pretty hellacious things. So.
Yeah, I mean, and then it's, again, that's kind of what I talked about where people have coverage, but it's not quite to the extent that they thought it was. And the unfortunate thing is a lot of times you don't find out until the accident's happened and the claim's getting paid, and what you have is what you have at that.
And it's that thing. Insurance is that thing that you always wish you had more of when you look back.
Right. So I call it competing interests. When you're buying, it's human nature to want to try to feel like you're getting the best deal or the most cost-efficient policy. But then when a claim happens, you want to make sure that you're fully covered and fully
your cake and eat it too.
Fully covered and cost efficient. You have to. It's our job to try to find the right balance that fits for people.
And that's what you do versus someone shopping online and just clicking numbers.
Well, yeah. When you're shopping online, you're choosing your own limits at your own discretion, and that's fine as long as you know understand what you're purchasing. So.
Right.
I like to feel like we have value there where we can have a conversation about someone's real life situation and make a recommendation that fits them in a coverage standpoint and is still as cost effective as possible.
Sure.
That's really what we do. That's the essence of our job. Yeah.
Not overinsure, not underinsure, and find the best deal that you possibly can based on their risk.
Correct. On
their profile. So what would you look at in terms of someone coming to you and how do you determine the amount of liability coverage they're going to need? At least from the auto side.
So it's a few things. First and foremost, like the easiest indicator do you own your home? How long have you owned it? That tells us, what type of assets they have that we're trying to protect in the event of a loss. If they own their house and they've owned it 20 years and they owe $80,000 on it and it's worth $400,000, we know in the event of a loss, boom, we have a $320,000 asset that's immediately at stake. And so we have to make sure that we at least recommend coverage that protects that. Another thing is, what do you do for a living? What is your income level? Because future wages can be garnished as a result to remedy a judgment. So those are things that are at risk. What's your retirement plan worth? There's some. So it's really the net worth and income level of that person that we want to try to learn as much as we can before we recommended coverage limit.
Those are all great points, John. I want to thank you for being here. We're going to take a quick break. This is Total Financial Solutions Safer Money Hour. I'm Jeff Gerard. We'll be joined by Mr. Arif Halaby when we come back from the break. Every week this time, be sure to stay tuned when we come back from the break. More tips and tricks for you. Total Financial Safer Money Hour on AM 1220 KHTS.